Hey there, Tyler Webb, the Bowtie Loan Guy here. Today we are going to be talking about this brand new CalHFA program that's coming out on March 27th, the California Dream for All. So first, a little bit about us. I'm with American Pacific Mortgage, the Temecula team, the Hartman team, and the Hartman team has been in the Temecula Valley serving all of California since 1989, and American Pacific Mortgage has been named CalHFA's top lender for the last few years here. So we are really, really excited about this program and how it can help even more buyers get into homes, especially those that didn't think that they ever would own a home. I am the down payment assistance specialist on our team, and I absolutely love what I do. Our team absolutely loves just helping clients get into these homes, especially, again, those that never thought that they would get to own a home. It's just really cool helping them understand and achieve that goal. Now, what is CalHFA? For those of you that don't know, CalHFA is the California Housing Finance Agency. It was established in 1975 to create affordable and sustainable housing, which is especially needed in a high-cost area like California. And CalHFA has so many different programs and tools that are awesome opportunities for especially first-time home buyers to purchase their home here. Now, let's dive into this actual loan program that we're going to be highlighting, the California Dream for All Shared Appreciation Program. What this is a no interest 20% loan, up to 20% loan that you can apply toward just your down payment or towards your down payment and some closing costs as well. And the way that it's paid back, as there's no interest on it, is through an equity share program. And it is a 1-to-1 ratio of the amount that you borrow from them is the amount that you owe back. So if you get the full 20% assistance, you will give them back 20% of your appreciation once it is time for repayment. And you don't have to take all of that 20%. You can take 10% as well, if that's what you're looking for. And borrowers that are under the 80% area median income mark, and we'll talk a little bit more about what that is in a little bit, but the borrowers that are under that level can access more of the assistance with a lower amount of the appreciation share being paid back. So jumping into a little bit more of the specifics of the program, I will preface this. Anything with an asterisk in this presentation represents something that we believe will be a part of the program, but since the guidelines are not out, we cannot say for sure. So there's a lot of information going on about this. So hopefully this helps clear up what we are seeing and expecting for this program. So the assistance, as I mentioned, is not forgiven. It must be repaid. And the way that that works is through that equity share. And the timing of that, the repayment being triggered, is through one of these three things. First, a refinance. Now, note here, we are hearing that there may be a one-time exception to this, where if rates drop a substantial amount and you're able to get a great savings, they're not going to make you pay back that assistance just yet. But typically if you later down the line are looking to pull cash out or something like that, then the assistance would be due at that point. Another trigger is selling of the property. And of course, if you hold out and keep that loan all 30 years, then you would owe that amount back when the loan has come to maturity. So question that we've been getting is, what happens if the property doesn't appreciate? Some types of properties don't appreciate as quickly as others. Don't worry. What happens with that is when repayment is triggered, and if there isn't any appreciation, you would only pay back the original amount that you borrowed. The buyer must occupy the home for 12 months at least, and this can be used to purchase a single-family residence, a condo, a townhome, or an eligible manufactured home. We say eligible because there are certain stipulations for these manufactured homes that they have to fit into these categories. So just something to keep in mind there. Also, this program, it's a conventional program only. It follows the conventional loan limits in the county that you're purchasing. So in most counties, like Riverside, San Bernardino County, the loan limit is $726,200. In other areas, San Diego, Orange County, Los Angeles, there are what's called high balance limits or high cost limits, and those are a little bit higher. Like in LA County, it's just over $1 million. It's $1,089,300, I believe. So it follows whatever the conforming loan limit is for your area. Now, to break down and kind of show a comparison of where the benefit of this program would be and how it works, we have this example comparing it to another type of a low down payment assistance or low down payment type of program here. A regular conventional loan, no down payment assistance, looking at just 3% down. And for this example, we'll use a $600,000 purchase price. Prices may be higher or lower depending on where you are purchasing. And with a $600,000 purchase price, 3% down, you're looking at $18,000. You have to add in the typical closing costs. This is a lot of times escrow, title, other fees, and costs of doing the loan. There are also prepaid taxes and insurance to fund your escrow account. So that makes up the closing cost portion of your cash to close. Oftentimes that's between 2 to 3% of your sales price. So if you have questions about what goes into that, feel free to message me after. But the expected cash to close for a program like this would be between $30,000 to $36,000. Again, greatly depending on what those closing costs are. Now, let's take the same home, same example, and compare that to a California Dream for All loan, $600,000 purchase price. CalHFA assistance, you get that full 20% down. And the assistance, again, can be applied in different ways. You could do a slightly lower down payment and put some of it towards closing costs. So you can make this work for you different ways depending on what your goals are. But the expected cash to close for this program drops from $30,000 to $36,000 down to $0 to $18,000. That $18,000, of course, just being those closing costs that would be involved with any transaction. So an awesome opportunity here for those of you who have been waiting to purchase for that down payment to be saved up for. Maybe a family member has said they can give you a gift at a certain time. This may help you circumvent that and get into a home sooner. So to break down how the shared appreciation looks, kind of a visual scale here, let's say we have a $500,000 home. You get the full 20% to assistance here to purchase. So you get $100,000 from CalHFA. Now, let's say in 5 years' time, the home is appreciated to $640,000. That may be high, that may be low, depending on the type of property that you buy, depending on the area where you purchase. But for this example, $640,000 value now. So that appreciation amounts to $140,000. You took the 20% from them, they get 20% of your appreciation, which comes out to $28,000. So when the loan repayment is triggered, in this case, you're selling this home, you would now owe CalHFA $128,000, and the remaining equity, in this case, about $142,000, would be given back to you when you sell the home. Now, this is comprised of the $112,000 in natural equity appreciation in the home, and then the $30,000 in addition is what you've paid down your loan throughout the monthly payments. So that's how we get to that $142,000 of total equity back to you, assuming the house sells for $640,000. And this chart just shows that the longer that you hold on to this home, the more equity you will get. But of course, the amount that they're going to get, the CalHFA will get, it still grows as 20% will increase as the value increases, but they're still getting the same amount. Your home should appreciate more and more and more as you hold on to it, so the homeowner equity will increase greatly as you go. Now, some eligibility requirements, again, note that asterisk there because we don't have the guidelines just yet, but based on what we're hearing, the minimum credit score will be 660 if you are under that 80% area median income. We'll touch on that here in just a second. Otherwise, if you make over that area median income 80% mark, you are looking at a 680 credit score. This is conventional only, as I mentioned earlier. If you're looking for an FHA loan, a VA loan, there are other options to help you with that. This program will not do so. We're expecting the maximum debt to income ratio will be 45%. CalHFA has this hard and fast. If you are 45.01, we need to look at this and see if we can get you back down under 45%. And the way that we calculate this is we take your gross monthly income, and 45% of your gross monthly income can be allotted towards your monthly expenses. So this includes obviously the house payments, but this also includes any student loans. Even if they're in deferment, we have to calculate a little bit into that. Your car payments, whether it's a loan or a lease, we have to calculate that. Credit card debt and other monthly debts that you may have, personal loans, something like that. This also takes into account if you co-sign for a family member's car, something else like that. If you're an authorized user on someone's credit card, be mindful of this. There are ways that we can help strategize and manage your debts. That way your debt to income ratio is at a level that's acceptable for the program that you're looking for. But keep that in mind. If you co-sign for someone else, especially like a mortgage payment, we're going to have to include that in your ratios. Now, these also follow income limits depending on the county that you're in. So Riverside, San Bernardino County, we have the same limits. You can make up to $173,000 a year and be eligible for this program. That 80% AMI, area median income amount, is just under $70,000 at $69,920. So if you make $69,920 a year or less, you have access to these slightly more favorable terms. 660 credit score, and you would pay back less appreciation than what you had actually borrowed. Now, San Diego County, you're looking at a $211,000 loan amount. Los Angeles, you're looking at a $180,000 loan amount. I'm sorry, income amount. And then Orange County, you're looking at a $235,000 income for the year. So as long as your yearly income is at or under this amount, you should be eligible for this program. And again, if you meet that 80% area median income amount, you get the more favorable terms. Now, for this program, you must be a first-time home buyer. The way that this is defined is someone who has not owned a home in the last 3 years. If you bought a home and it's been 5 years since you've been in it, 5 years since you owned that home, 4 years even, you are good. If it's been 36 months or more, you are considered a first-time home buyer. If not, you'll have to wait, and this program might not be the one for you, but we do have some other programs that may still assist you with that goal of home ownership. Just depends on what you're looking to do. So if you have any questions, feel free to call or email me. You can shoot me a text as well. That is my personal cell. I'm here to help any questions you might have about this and in your goal of home ownership. Hope you found this informational, and hopefully we will see you at one of our future videos. Thank you so much.